for more on our week of spooky stocks and how Target may or may not work for your portfolio, we turn to Mike Baker, D.A. Davidson Senior Research Analyst. And we're having some fun with this theme, obviously, Mike, but there is a serious question here for investors, which is, after some of these stocks have indeed spooked investors, is it time to come in? And I know that you take a more bullish view of Target, that perhaps some of the worst is behind it. What convinces you that it has gotten to that sort of turning point?
Yeah, well, it's hard to know if the worst was last quarter or this quarter or what exactly it's going to be, but we think we're close to the worst. One of the things we did was we took a deep dive into the margin structure and took a look at where the margins were prior to the pandemic. For the 15 or so years prior to the pandemic, their margins were between 5.5% and 7.5%, averaged right around 6.9%, but really never worse than 5.5%. They dropped to about 3% last year, and now they're about 4.5 on a trailing 12-month basis. We took a look at what specifically, we went through 10 or 12 different drivers, has caused that decline, and thought about how we think those can be in the future. And do we think next year, maybe the next 18 months, can Target regain some of the margin that it's lost? Are they a better or worse company today than they were prior to the pandemic? We think they're at least as good as they were prior to the pandemic, and that the margins should be able to come back to somewhere in that 5.5 to 6.5% range. And we think by next year.
So, Mike, you see the margins rebounding to like around 2017 levels. What would be the big risk to that call, Mike?
Sales. Simple as that. Deleverage on weaker than expected sales. We do think same-store sales will rebound next year. This year they're going to be the worst they've been, possibly ever as a public company. We do think they'll rebound to be positive in the low single-digit range next year, helped in part by easy comparisons, but also, this big inflation issue that a lot of consumers dealt with earlier in the year is starting to dissipate a little bit. We're getting a little bit of disinflation. We think that did a lot to crowd out some of the discretionary products that Target specializes in. That should be better next year. So we think that the sales can rebound, and that can help with the margin structure as well.
And Mike, what about the shrink issue, right? The theft issue. Obviously, it's affecting a lot of retailers, but Target has talked about it more than most. Do you think they've gotten their arms around that?
Yeah, so when we did our deep dive on the changes in the margin structure, and again, we looked at 12 or 13 different metrics, that wasn't the biggest driver of the margin decline, but it was the second biggest driver. So a big issue. We do think they've gotten their arms around it, and at the very worst, it doesn't seem like it's getting any worse right now. So not necessarily getting better, but won't be that drag, next year at least, won't be the drag that it has been this year. It's sort of leveled off. They've taken a lot of steps to try to mitigate it. Closing stores are for one. But now they're one of the issues where they weren't adequately accruing for it in the past. Now they've caught up there. Again, it doesn't necessarily get better from here, but we don't think it gets worse.
And Mike, Target also, it found itself in the middle of the culture wars with the Pride merchandise. Is that problem, that challenge, Mike, is that in the rear view mirror now for this company?
Yeah, well, what I'd say about that is that their same-store sales, if you go back and listen to how they talk about that, even prior to that hitting them in June, so if you go back to May, their same-store sales were, I believe, down 3% in May, prior to that issue even cropping up. So while that was an issue over the summer, they had problems prior to that. So I don't think you can ascribe all the problems that Target is having to that issue. I think it's much bigger than that.
Yeah, and it seems to me also that Target, this is something we talked about a little bit at the time, that Target's been fairly consistent with its offerings of that kind of merchandise and its sort of brand identity. So if anything, it's that its customers changed or the culture changed, and not necessarily that the company itself changed, right? I don't know. Maybe that's not the right way of the situation. What do you think?
It's a tricky subject, of course, and I think it just got a lot of airtime over the summer. But again, I think that's a smaller issue as it relates to the overall financial performance.